Good afternoon, everyone, and welcome to another Investment Insight Call with Nedgroup Investments. I'm joined today by Jannie Leach, Head of Core Investments at Nedgroup Investments. Jannie and his team have been responsible for the creation and design of our rules-based range, which consists of 4 funds: the Core Accelerated Fund, Core Diversified, Core Guarded, and Global Core Funds. Jannie, maybe just to start, can you just remind us what rules-based passive funds are, what the rules set for the core funds are, and how do they differ from other passive funds?
Good morning. So basically, rules-based investing is the umbrella term that sort of encapsulates your traditional market cap index funds. So those are like a All-Z tracker, etc. That is where the name passive came from, because there's no active bets versus the market. The second type is your enhanced index strategies like smart beta, and then the third type is the multi-asset index funds. Now, clearly, all of these funds can't be passive relative to the market. So a lot of the smart beta funds, for example, like a Divi Plus fund, could have material tracking error versus a index benchmark. The thing that they all have in common is that they all follow predefined rules that define the weighting of holding shares, etc. Within the fund. It defines the rebalancing frequency, and in the case of multi-asset funds, it also defines the asset allocation. Now, within the core funds, the philosophy that we apply to come up with the rules that govern the management of the fund, we looked at a number of factors, and I mean, we felt that certain things like, for example, investor behavior, risk management, and cost and implementation efficiency were really important in the way that we designed our funds. And what those criteria effectively meant was that the rules that we came up with in the core funds were basically that we'll only have long-term strategic asset allocation, and that the underlying benchmarks will follow market cap indices. And then these funds would be rebalanced on a quarterly basis. Now, as you can imagine from the sort of the range of different kind of rules-based strategies that are available in the market, is that you can actually go and package these multi-asset funds in quite a number of different ways. So you can go and do tactical asset allocation, you can incorporate smart beta, you can have different forms of asset allocation, etc. And I think this is really where the core funds are quite different to a lot of their passive peers, in the sense that we don't use any tactical asset allocation or smart beta. And the main reason for that is that if you think of your investor behavior, we wanted these funds to be the one portfolio in a client's funds where an advisor would not have to go and explain relative performance risk. So not explain why a smart beta strategy has underperformed, or why your tactical asset allocation calls went the other way.
Jannie, many market participants have commented that good active managers will tend to outperform passives during severe corrections or market crashes. Can you maybe just comment on how the core range of funds is done through this period relative to active managers?
So I think firstly one needs to look at active management as a collective. And if you look at active management as a collective, it's only a small percentage of active managers that actually provides better downside protection in a market crisis such as we're currently experiencing. The vast majority, by definition, will underperform after fees. Now, when you get to multi-asset, you actually have additional layers of complexity, because you're not just looking at relative performance on a single asset class, but you're looking at over 7, 8, 9, 10 different types of asset classes. Some of those become extremely correlated within a crisis, and so the outcome can be even more significantly skewed towards the cost benefit. And then an important point is that when you look at the managers that have outperformed, quite often they may have outperformed in 1 or 2 market cycles, but for example, currently they are in line with peers. So it doesn't necessarily mean that if you've been able to get your calls right in a previous market crisis, that you would get it right in the next one. Now, if we look at the core funds' performance through this volatile period over the last 2 to 3 months, I think the funds have held up quite nicely. I mean, most of them are in line with the big brand peers. So if we look at the core diversified fund, that was down by about 11.5% in March, which is in line with most of the big brand funds that were down by between about 11 and 14%. I mean, there are exceptions that some of the fund managers were down by 18%. And then there's one or two of the big brand funds that have held up quite nicely. But those two, I would say, are the exception. The vast majority of funds were sitting in that sort of 11 to 14% bracket. The core accelerated fund, of course, is a lot more aggressively positioned than its balanced peers. So it's got about 90% in risk assets versus about 66, 67% for most balanced funds. And that was down by only 14%. So if you think it had more than 20% in risk assets versus most balanced funds, and it was only down by about 2 or 3% more. It sort of gives you an idea of how we've constructed the portfolios to withstand market drawdowns. And I mean, the main reason for this is that the funds have got very broad diversification across asset classes. Well, there's about 10 different asset classes in the funds, and within each of those asset classes. So we've got a full 170 shares on the SA equity side, and we've probably got about 4,000 or 5,000 shares inside on the global side. Then the other factor, and if we look at the rebound that happened in April, the core funds have done better than many of these peers, and one of the reasons for that was that we rebalanced the portfolios at the end of March as per the rules, and so it meant that the funds had full exposure to risk assets when the actual rebound came through, and that's definitely helped the funds if you sort of look at it through a cycle of having a pullback and then a recovery.
Thanks, Jannie. And we've certainly been through unprecedented times at this point. Would you consider making any changes to your strategy? Example, your strategic asset allocation. The funds are built on long-term strategic allocations. Are you sort of looking at that at this point in time?
Look, so I think, Rob, whether you're managing a active or a passive fund, I mean, if you want to make changes during a crisis, I think it's a little bit too late. I think some managers get the timing right beforehand, so in other words, by moving into cash before a crisis actually happens. But I think the key is to have a portfolio strategy that works throughout a cycle. And if we look at the 11 years that we've if we look at the research we did 11 years ago on asset allocation, we went and we focused a lot on what would be the kind of asset classes that would help you in market crashes like we currently experience. And one of the ones we found was global fixed income in the rands, because you got sort of like two drivers for that downside protection. On the one hand is that a lot of investors move into global fixed income, and then on the other hand, quite often the rand depreciates, and so you get the double movement of the rand and the global fixed income not falling as much as equities. Now, the funds have been around for about 11 years, and they've been through bull and bear markets, and I think in both they've fared quite well. I mean, they've basically been in line with a lot of their peers, whether it was in market movements going up or down. We are always doing research on structural changes, because if you think of long-term strategic asset allocation, the things that would change that strategic asset allocation would be if there's some fundamental change in the structure of the asset class. Now, one of the examples of such a structural event is what happened in the listed property space, where we started seeing increasingly a difference between your traditional real estate investment trusts that are what I would call traditional property, where it's got the property asset class characteristics, versus the new development holding companies that are in the real estate sectors, but they behave more like equities. And so what we decided at that point is to change our property benchmark from the SA property index over into the REIT index. I think the third and last point is that it's also quite important to note, because these funds are following rules-based benchmarks that are market cap, there are no active bets within the funds, and so there's no overweights to a Steinhoff or more recently Sasol, which could have marked impacts on the fund's behavior within that market environment.
Jannie, you also earlier mentioned that the portfolios follow certain rebalancing rules set for asset allocation and the underlying benchmarks. You also mentioned that the funds recently went through a rebalancing process. Can you maybe just talk us through that rebalancing process and give us a little bit more detail around that?
So the core funds are typically rebalanced on a quarterly basis. It's usually around the time that the standard indices like the all-share index gets rebalanced. When we balance the underlying benchmarks, we also rebalance the asset allocation. And then what we typically do, because the funds have sort of been receiving regular inflows, we also use those inflows to start moving the fund closer to the target benchmarks towards the end of a quarter. Now, in extreme market events like what we've currently experienced, we've also set tolerance bands to make sure that the funds remain within their mandates. And so these tolerance bands are about 10% of the asset class weighting. So, for example, if we look at the total equity exposure in the core diversified fund, that is 67.5%. And therefore 10% of that is 6.75%, but I mean we've sort of rounded that down to about 6.5%, and so we'll allow the portfolio to move either up by 6.5% or down by 6.5%, in which case we will actually rebalance the portfolios back to their midpoints, irrespective of whether we are at a quarter end or not. We were quite fortunate in March that the March rebalancing coincided with such an event, and so that event happened at the same time as our standard rebalancing, and so we didn't have to incur any additional investment costs.
Jannie, just to change tack a little bit, over the last few years in dealing with clients, many of them have expressed fears regarding the impact of ETFs on markets. And one of these concerns is all around liquidity, particularly during periods of a market drawdown or market crash. Has there been any issues regarding liquidity with regards to the core global fund that holds large amounts of cash in ETFs?
So the core global fund only invests in liquid asset classes, and so it will only hold government bonds, and it will only hold really large global corporate credit. It does not hold anything like high yield credit, and so those kind of asset classes where there are bigger liquidity constraints in the underlying won't have an influence on the fund. The second point is that the core global fund uses a combination of index mutual funds and ETFs. Now, BlackRock manages or does the implementation of the fund, and they are the largest asset manager in the world, and they've got the scale and the expertise to use the two structures in an appropriate combination to deal with liquidity challenges. It also allows them to sort of optimize things like your cost and tax efficiency, your market coverage, and reduction in cash drags on top of managing the liquidity in the funds.
Most users of the core funds use them as part of a portfolio that includes both active and passive. Could you comment on the benefits on combining active and passive strategies in a portfolio?
So I think most intermediaries use multiple fund houses. And I mean, the main reason for that is that they want to mitigate their business's institutional risk. In other words, if there's something happens to one of the fund managers, at least it doesn't expose their client's portfolio to that event. In other words, they don't have to switch all the assets in one go. They only have to deal with one fund management house. But what that means relative to a rules-based investment strategy such as the core funds, where we've sort of minimized manager risk as much as possible. I mean, there's no tactical asset allocation calls and there's no active bets in the underlying. Basically, these multi-fund house portfolios will have some forms of manager risk. And then in many cases, quite often, there are duplication. In other words, fund management houses that hold the similar asset allocation views. Or in cases where the equity carve-outs are very different, what you actually end up doing is that you end up creating almost like an expensive passive holding. And this is really where the core funds, I think, can make a big difference. Is that one, you are introducing a fund where you've reduced the manager risk. Two, you can deal with those overlapping or that over diversification elements, and sort of you can be far more selective in the kinds of active managers that you can blend with a passive funds. And then three, quite importantly, is through this you can actually end up with significantly lower TICs but achieve the same return and risk outcome over time.
Jannie, I think we need to call it there. Thank you so much for your participation today and for sharing your thoughts and ideas with us. I think one of the key takeouts from me is certainly that the funds have delivered what's on the tin, and they've held up very well versus their active peers. If anyone is needing any further information on any of the core funds, or if you have any follow-up questions regarding today's call, please contact your Nedgroup Investments Relationship Manager and they will gladly get back to you with the response. Stay safe and good afternoon.